Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right. Paul Winkler, Investor Coaching Show. So one of the things that I hear from financial advisors, financial firms, mutual fund companies, you'll see this stuff everywhere, the 4% rule, right? You know, if I have $1 million portfolio and I take a 4% distribution, $40,000 out first year, and then I increase it for inflation. So let's say the year's 2000, I take 40,000 out, 2000. The next year, you got an inflation rate of about 3.39% was the inflation rate. So the next year, you're taking out, you have a little bit higher amount that you take out, 40,620, and then you have inflation again. So you take out 41,586 the next year, and next year, 2003, you take out 42,300, and then 43,700, and 45,200, and 46,390, and 48,000. And eventually, what happens? You get to the end of 2024, the amount of money that you need to, what 40,000 would have purchased in year 2000, it takes 72,552, using the CPI, the Consumer Price Index. So literally you're looking at it and go, wow, 40,000. And now it takes almost $73,000 of income to buy what, and that's just over a 24-year period, right? 2020, I guess 25 years technically, 2000 and 2024. And as you look at it, they go, wow, that's a pretty big increase. So, when people go into retirement, they're afraid, hey, I don't want to run out of money. So a lot of times what people will do is say, well, if investment advisors will do, they'll say, okay, well, just buy this annuity. And then you'll have guaranteed income. You'll have an income stream, you'll have this base of income that comes in. And what they don't necessarily get into explaining too well, from my experience, is that purchasing power just keeps going down, 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 and down over time. So, you may start off with $40,000 of income, but then, by the time, a few years go by, you're living off of the equivalent of $20,000 of income. And you go, well, gee, I needed 40. I needed to keep pace with inflation. And that's not what's happening. And quite frankly, if you look at some of the things we've been talking about this show so far, what's the big concern about the future? The big concern is that the dollar will continue to drop in value, versus other currencies, and just, versus the value of goods and services out there. You'll see the prices go up and up and up, which is just a reflection of the dollar going down in its purchasing power. I mean, that's kind of rough when you're in retirement. You get, 20 years into retirement, you can't go back to work. So you want to avoid that. So the 4% rule was this idea of, what if I diversify large companies, small companies, value companies, growth companies, and, bonds and stocks, and I take an income in a method that's prescribed. And if you've never heard me say this, how do you take income? Let me just explain that really quick. Let's say that I have 10 asset classes, and I have, 10% of my money in large companies, and I have 10% of my money in value companies, small value companies, let's say, and I have 10% of my money in large value companies, and 10% of my money in small cap stocks, and 10% of my money in international large, and 10% in small company international, and 10% in emerging markets, and 10% in, 5-year bonds, and, 10% in small, let's say short-term bonds, 1-year bonds or something like that. So just say that I had 10 asset categories, and I have 10% of my money in each one of them. This is an oversimplification, but this is the idea. In any given year, one of those things is going to have a higher return than something else. So what I'll do is I'll scrape money out of whatever just had the best performance. Whatever has done better, I'm going to take my money from that. So if large U.S. stocks rally, and now it's not taking up 10% of my portfolio, but 12%, I'll take, the 2% overage out of large company stocks. And then, maybe next year, large company stocks, tank in value. And now they're only taking up 7% of my portfolio, but my bonds are taking up 13% of my portfolio. So I'll scrape my income from the bonds. that particular year. And that way I'm not selling the stocks low. I'm avoiding selling anything that has gone down in value or selling as little as I can possibly get by with selling. Now, the research on taking income showed that that's basically the way you do it. You take income in that particular manner. And one of the things that, you hear people do is, they will actually take money in an even manner. Jonathan talks about this. When he worked at the banks that he worked at, that's where Jonathan came from. He's several of the large local banks. And he says, he said, Paul, before I met you, what we were taught to do is you might have 4 mutual funds and you take 25% of the money out of each of the 4 mutual funds. And he said, it never occurred to us. We weren't taught to do it the way you're talking about. And I said, well, that was the research. The research shows to do it that way. And I'm pretty dogmatic that I'm going to follow the research. It makes sense. So what we did here in the office this week, as I was talking to Scott, I says, hey, Scott, here is the Dalbar data on asset allocation investor returns. And they went through, they go and look at actual money flowing into asset allocation funds, money flowing out. When do people invest? When do they take money out? What's the management of the funds, the returns of the funds? Are they using tactical asset allocation in the funds? Are they moving money between stocks, bonds, and cash based on what they think the market's going to do? So what do they estimate the return of the investors in these asset allocation funds, which is what I'm supposed to take my 4% distribution from? What were the actual returns back through history? Well, what we did is we took the data from the time that I opened the company here, because I was just talking about what if I took $40,000 out and I grew it to a $72,000 distribution, 25 years later. And I talked about how, if you had followed the academic research as I talk about, you would have been fine. Well, what would have happened had you done it based on the research and the data on the asset allocation funds? You would have run out of money. You would have run out of money is what we found. You literally ran out in 2024. You ran out. You'd be in the negative. So not only did your income not stay pace, but you're out of money too, right? I mean, can you imagine? You're like 60 years old. You retire. You start taking an income at age 84. You're going, oh, well, I don't feel dead yet, and you're out of money. I'm just like, how awful is that? And why is that? It is because and this is data using, they're looking at mutual funds, they're looking at investor behavior, they're looking at investment advisor behavior in this data. And you're looking at a pretty dismal picture. And this is something I've talked about for years. This is what's going on. I started this radio show in the year 2001. And I'm using data back to 2000. Did they fix the problem that I started the radio show based on? That there is dysfunction in the way money is managed. Apparently, they did not fix the problem. The investment industry did not fix the problem because we're seeing the same exact thing. So I guess maybe it's job security around here. It's unfortunate, but it is. It's job security. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.